Yeah, so we are going to talk about every doctor's biggest expense, which is taxes. And what we're going to try to do is change around the perspective from something we have to deal with once a year and are kind of dreading and comes kind of to surprise us every year with how much we're paying and what we have to do at the deadline to something we're proactively planning for and dare I say even looking forward to as we start to figure out ways to optimize the taxes we'll pay, I'll say. So I'm excited to have Laxman and Kim here from Doc Wealth, really unique tax management advisory firm that is doctor founded and specifically focused on physicians and their taxes. So uber specialized, has tons of knowledge and experience with this stuff. And so they are going to go over with us kind of like the common mistake scene, like real world examples, and also answer any questions. So that's a big part. Like if you guys have questions, please throw them into the chat. If you want to, you can unmute yourself and just pop in and ask as we go. We want to keep this conversational and casual, but this is really a unique time to have access to folks like Laxman and Kim to really answer any questions you might have. And even though it is July, this is like the perfect time to be thinking about this stuff because you don't want it to catch up to later in the year. So with that, Laxman, Kim, I'll turn it over to you guys and really excited for a very educational talk. And I know I'm going to learn a lot as well.
Awesome. Thanks, Jordan. So, Kim, do you want to share the screen?
Absolutely.
Um, yeah. Good evening, everyone. I'm Laxman. I'm one of the founders of Doc Wealth. And then we have Kim here as well, who's the director of tax planning. The goal of this is very much to be educational. So if anyone has any questions as we go through the topics, feel free on the chat or just ask the question live. Um, So we'll probably start off with just kind of giving a quick background, and then we'll dive into all the different tax strategies to hopefully that can be helpful to mitigate and lower your tax bill, come April. So as Jordan said, we are physician founded. We're founded by Dr. Mark Applegate, who was my college roommate a long time ago, and myself. I have a tax background. I got my CPA about 16 years ago. But the origin, quick story is like many of you probably have gone through, once, Mark became an attending and he started to make a lot more money. He saw a pretty large tax bill and he wasn't really able to find a tax provider that was very well versed because he was a mix of W-2 and 1099 income, which makes it very complex very quickly. And so someone who's able to handhold, understand, walk you through exactly what are the different options and be very well versed with physician income. Because the reality is at this income range, and when you have more complex investment structures or K1 1099 income, taxes quickly go beyond probably 99% of tax professionals. And so he had three different tax professionals in 3 different years and was not happy. And so he called me up and said, "Hey, let's focus on something that's purely focused on physicians because none of my fellow attendings are happy with their tax person." So if you go to the next slide, this is a quick background on us, but yeah, my background is very much worked at a lot of several Fortune 500 companies, and so really helped build this in from like Mark's point of view, his vision as like a physician-founded physician point of view. We spoke to probably 700 physicians when we started this, and we asked what were the 5 to 7 biggest pain points you're facing with with your current accountant, and let's focus from that point of view. And so now today, about 3 years in, we work with more than 1,000 physicians in across 50 states. And the main approach is very different. It's personalized. We're proactive. So we're talking to you throughout the entire year because proper tax planning to really mitigate a tax bill, you have to focus on what strategies you can do, whether it's investments, whether it's retirement planning, whether it's, is it possible to get my spouse, my kids on payroll? And how do you do it compliantly and legitimately? So it's going to be basically audit proof in a sense. So that requires very personalized tax planning throughout the year. to go and implement this, because you have to do this in the year to be able to get the benefit come April of the following year. So hands-on, we're very much education focused as we're doing everything. We understand that most of our physicians don't have a finance background. And so we really are big on education. We're have probably every strategy we do, we kind of go from A to Z. How does it work? Why is it? What are the pros? What are the cons? And then how do we streamline this as much as possible so that it doesn't suck up a lot of time of your day to go implement it? We can go to the next slide. And so, yeah, I'll hand it over to Kim. Kim is definitely the expert by far in the tax planning and strategies. Kim, feel free to give a quick background on yourself, and we'll dive right into the different strategies that probably make sense.
Thanks, Loxman. I'm Kim, as Loxman mentioned, and I am the Director of Tax Planning at DocWealth. I have a little over 17 years in experience in taxation and tax planning, much of it medical specific. And I absolutely love helping our physicians not pay a dime more than they're legally obligated in taxes, is the way I like to put it. Everything legal and above board, of course, but we love to make sure that it's not your largest expense related to your business. But what we do see most often with clients coming to us is that it's not optimized and they're leaving money on the table. And a lot of those things that we see is they don't have the most advantageous entity structure for them. So they're operating maybe as an out of date or entity structure that doesn't serve their purpose best, or they're not taking into account all of the states that they need to qualify in as they add locations or add on telemedicine or whatever have you. And we often do see the kids on payroll not being done correctly. So maybe they're paying their children, they're not running it through payroll like they're supposed to, they're not documenting it correctly, or making sure that the work is age appropriate and legitimate, things like that, that in the case of an audit, it would be taken away from them, that deduction. We also see some timing and planning mishaps, not taking the quarterly projections into account and making quarterly estimated tax payments, waiting just until filing season when there are pretty much no moves left that they can make to mitigate their taxes at that point in April. And they're not visiting their W-4 and adjusting that as needed throughout the year either. Then we do see people too that an S corporation election, which is one simple filing, has not been made, even though it would save them quite a bit, 15.3% often on a large portion of their income is what they could save with an S corporation election. Or maybe they've made an S corporation election and in their specific area, it's not most advantageous for them. We also do see some state things with S corps that really inhibit the ability to make that election and see those savings there. And then we see multi-state tax that isn't being taken into correct form there. So they're operating maybe across multiple different sites or states and not taking that into account, not registered where they're supposed to be, things like that. And then we do unfortunately see some things that could trigger audits, such as round numbers, which the IRS sees as obviously if there's multiple round numbers, they're probably just making this up. Deductions that are too high comparatively to their revenue, no record keeping or thin record keeping, and then losses shown year after year on the Schedule C. So these are the type of things that we see when clients come to us. And then we do help them implement these different tax planning strategies and optimize their taxes. And it really compounds year over year. It's not just this year that it affects. Each year worth of planning sets you up for the next year and sets you up for success in the future. And every year that you put more money in your pocket just gives you that much more money to invest in tax advantage strategies in the future as well. So consistent planning really puts you in a strong position each year, and each year that gets stronger.
Yeah,
So
and just
planning
to,
ahead. Mhm.
yeah, sorry, Kim, just to add to that, that prior slide was really kind of highlight probably 6 of the most common mistakes or issues that we've seen when someone kind of comes over. And really what it's meant to show is that when you are taking advantage of the tax strategies, it is very important that things are done properly and compliantly. Most times, we hear physicians say, yeah, whenever I ask my CPA, hey, can I do this? Can I write off this expense? They typically say no, no, no. And usually that's because it's probably quite complex from the compliance point of view. So we really take time to make sure, like, if it's multi-state compliance, are you paying the kids? How can you do it appropriately and legitimately? Because everything, we want to have enough time to document and ensure that we have the right processes in place to be able to optimize. And as you're seeing on this screen, typically um, W2 versus 1099 has 2 different sets of strategies. 1099 has the entity structuring, has a lot of the multi-state, because the tax code is built for business owners. When you're W2, you have to invest typically to become a business owner. So when you own real estate, that opens the doors to implement a lot of these tax strategies that you're still seeing: entity structuring, paying kids, retirement accounts. And we'll kind of go more in detail over all of those. But even what you save, if you're able to save $15,000, $20,000 in a year, that compounds every single year by retirement pretty significantly. But yeah, back to you, Kim.
Yeah, and we will get into each of those points in more in depth here as we go. So one of the things that Loxman was just speaking to is business really does unlock a lot of potential for you. So with a W-2, you do have the pros of simple, straightforward filing, and the employer withholds a lot of the taxes for you. But on the flip side, you don't have the deductions you can take against that income, and there's much fewer planning options. The investment options are still there, but not as many planning deductions, things like that. So you don't really have a lot of control over the taxes as a W-2. And a lot of what you can implement is limited to retirement and saving options like HSAs and things like that. You can, as Loxman mentioned, get into some of the more investment style options. There are some tax advantaged investments out there that are great for W-2 employees, but where you really, really unlock that potential is when you do have 1099 and or K1 income. And those come with a lot of pros. The business expense deductions that you can take. You can then implement home office and mileage strategies related to your vehicle. You have advanced retirement options available to you at that point as well. So you really have a lot more control over the end tax result, and you have a lot of options to manipulate that. And then the planning that's available to you is just that much more. Unfortunately, though, with that does come more complex filings. So most people, if not all people in the 1099 and K1 arena, really should have a firm on their side helping them file these taxes. They should not go at it alone on TurboTax and things like that. You'd be leaving a lot of money on the table, and B, you very potentially could file something incorrectly and cause yourself a lot of headaches. So typically the complex filings really do lead to a firm being the best bet for filing purposes. And there are also the need for estimated taxes, typically, because there's no automatic withholding through your employer and remitting of income taxes, typically. And it does come with quite a few increased compliance requirements, which again lends to being best for you to work with a firm to meet all these requirements.
Yeah, and just to add to that, for those that are W-2, I was W-2 for 10 years, and I used TurboTax, and it was perfect. TurboTax is very much an algorithm that's made for 99.9% of the population. it does not even remotely have options when you have, cost segs or more advanced strategies. And so it really limits what you can write off. So, typically the way we think about it is if you invest into, tax planning, you should be able to see 3, 4, 5x return on that. And that's typically what we see. And so it's a huge ROI in that sense. But for those at W2, the two main strategies that we typically see are real estate investments. So many of you probably have seen something on social media about bonus depreciation, buying a short-term rental where you can suddenly do 100% bonus depreciation. That is probably one of the most common and powerful strategies out there. I know Jordan has spoken a lot about this in different articles, but buying an asset, creating cash flow, and on top of it, this year in 2026, you're able to do 100% bonus depreciation. So as an example, if you buy a $500,000 property, a ballpark 25% of the property's value is probably going to be deductible. So that's $125,000 deduction on your tax return. And that's coming from your highest tax bracket, since we live in a marginal tax bracket system. So many of you are hitting 37%, in marginal tax rate. If you're making, over 450,000 or so, that's 125,000 deduction right there itself. And it opens the door where all of your income and your cash flows is now eligible to use what Kim was talking about on business deductions on the right side, the home office, the mileage, all these things. So it really compounds pretty powerfully. And you can do it W-2 or 1099 income, ultimately at the end of the day.
And Jordan, let us know if anyone has any questions in the comments here, because I'm not able to see that sharing my screen.
Absolutely, I will. None yet, but definitely encourage people as they come up, throw them in. I will moderate.
Awesome. Thank you so much. So as we mentioned, we do have some really great tax planning opportunities available to us, especially once you do reach that business 1099, K1, or even a real estate opportunity like Locksman was saying there. You do then get business expense deductions. You're able to deduct ordinary necessary business expenses, supplies, software, insurance, all those types of things. And then we're also able to really expand on retirement contributions. So you can do anything from a solo 401k or a SEP IRA to cash balance plans, which allow for much larger deductions and contributions there. And those are always great because you're receiving a tax deduction and you're sacking away for your own retirement. So it's kind of like a twofold deduction and benefit, so that those are always really great to be able to reduce your taxable income and have that money be sacked away for you for the future. Then there's also the deductions related to your home. So we have the home office and Augusta strategies, things like that you can take a lot of times. For the home office, you have that regular business use in your house, and you get to receive a deduction related to the use of that space in your home. And then there's also some items that we can tap into related to entity formation, maybe making that S corporation election if it makes sense for you. You're able to reduce the self-employment taxes, and then also with a reasonable salary and all of that related to the S corporation. Then you also have PTET that you can take, which is the pass-through entity tax that allows you to tap into some savings that was done away with in the Tax Cuts and Jobs Acts of 2017 when they limited state tax deductions on your Schedule A for your itemized deductions. So the states came up with a way around that in the pass-through entity tax deduction, where you're able to make an election and reduce your taxable income to the business for that purpose. And then that Augusta rule that we mentioned as well before, which comes into play with S corporations when you have that business outside of your personal name. So all of these compounding together is where the savings really comes in. Each one, is a great savings in and of themselves, but when compounded together is where you really see that fantastic ROI that Locksman was speaking about, 3, 4, 5 times what you would typically see or what you would not have if you had not done tax planning throughout the year. And we're just looking at the end of the year tax filing like most business owners do, unfortunately. And within those business deductions, we have a few different categories that make that up. You have your direct expenses, supplies, clinical and office, software, insurance, things like that, are boring but necessary in every business. And then you have your professional services like our accounting services, legal advisors, billing, things like that. Again, kind of necessary and boring, but a great deduction anyway, and something you can write off, as they say. And then you have your indirect expenses, such as utilities and rent or mortgage, interest, internet, things like that. And then business travel, lodging, all sorts of airfare, mileage, 50% of your meals, only 50% is deductible. And anything in between too. So like anytime you are doing something that is related to business, oftentimes you can write that off and get a deduction for it. And oftentimes clients that come to us from other firms where they're filing just once a year don't even really know what all their business deductions could include and what they could deduct if they had someone letting them know, yeah, sure, you can deduct that. And a good mindset that I always tell people is if it has absolutely anything to do with the business attempting to make more money, or anything to do with advertising that business or reaching out to potential new, in this industry, maybe patients or whatever have you, colleagues that you can connect with and things like that. Anytime it has anything to do with that, typically it is deductible. And a lot of times people are leaving money on the table by just not really realizing how much they can deduct or what can be deductible if they were to frame it in the right mindset, right? So a good way to look at it is not, is this a business deduction? It's how can I frame this to be a business deduction a lot of times.
Yeah, and also it's very important that you understand the list of things that are deductible, and then you say organized. A lot of times, what we see is that there's no sense of organization or keeping receipts. Maybe you're mixing your credit card or what you're using, like for personal and business expenses. Business items really need to be kept separate and organized so that you have as a backup. Bookkeeping comes a long way. And it's not necessarily that you need like a QuickBooks or anything, but just keeping an Excel or keeping all your expenses that are deductible on one single business credit card goes a very long way at come filing time.
Yeah, and very important, because if you don't keep them very organized, you will inevitably forget stuff and leave money on the table that way. Every business deduction that you do not list and do not deduct from your taxable income is money left on the table. And you're just handing money over to the government that you didn't have to. We also do have a lot of really fantastic home-based tax benefits. As we mentioned briefly earlier, there's the home office deduction, which is representative of a portion of every expense related to your home. And that portion is in direct percentage of the office space versus the rest of the home. So if your office takes up 10% of the home and you have $60,000 worth of expenses related to the home, for example, then you would receive a $6,000 home office deduction for the year. And those expenses include utilities, insurance, repairs, maintenance, don't forget security, pest control, literally every expense related to the home. And then you get that percentage of expenses as a deduction. And the other really great home-based deduction is the Augusta rule. Now, you do have to have a separate entity in place to take advantage of this, not as a sole proprietor. But with that added entity in place, you're able to take advantage of the Augusta strategy. And the Augusta rule, as they call it, is a tax caveat that allows that as long as you rent your personal residence for less than 14 days throughout the year, or 14 days or less, then that income is not taxable to you. So, of course, business owners use that as a loophole to then rent their personal residence to the business for those 14 days. And that money is not taxable to them personally. So you get to reduce your taxable income to the business and don't have to pick it up on the personal side. And that rental can be used for any business purpose. It does require someone from outside the home to be there and present for this meeting, but it can be meetings with patients, potential patients, staff, colleagues, coworkers, anything, someone else who owns a business, someone else who is a physician, anything that you could have a business purpose for. And you just keep that documentation. It's pretty simple to document with meeting minutes. And as long as you have all of that, in the very rare case of an audit, you would typically be able to keep that deduction. So easy to kind of audit proof, quote unquote, as they say, and a really great deduction. Something else that you're able to do with that 1099 and or K1 income in a very advanced fashion comparatively to W-2 is building generational wealth. And one way that you can do that is through different retirement plans. The SEP IRA is a good one. However, qualifying that with a lot of times physicians, it's not the best one for if they participate in backdoor Roth contributions each year. And the reason for that is because a SEP IRA does fall in the pre-tax IRA bucket for the purpose of the pro rata rule. So any funds that you have in a SEP IRA as of 12/31 of that tax year will poison a backdoor Roth contribution pro rata rule and will cause a portion of that conversion to be taxable to you. So typically that's not the best option ongoing for our physicians, but we do see that being a good option for certain specific scenarios. And then there is the solo 401k, which we do see much more typically as a fantastic ongoing retirement fund for our physician clients. And that allows for 2026 up to $72,000 with a catch up if you are over 50. And the solo 401k alone is fantastic. But then you're also able to have, in addition to that, if you'd like, or standalone, what's called a cash balance plan. And that one is where the real money is saved in more ways than one. You're saving money on the taxes as well as saving that money for your retirement. So again, just one of my favorites, those retirement funds. And a cash balance plan is a much larger option for sacking away huge amounts for retirement. And you can typically sack away 100,000, 200,000, 300,000 very easily with those. And the one caveat with cash balance plans is they are by the IRS considered to be a permanent fund. So if you aren't sure that your income is going to be steady for the next around 5 years or so, it may not be the best option. But if you are in a position where you are, pretty sure anyway, that the next 5 years or so are going to be high enough earning to not need those funds to live off of in that current year, then sacking them away for retirement and reducing your taxable income by that amount is, kind of a no-brainer and also just monumental for tax savings. So retirement funds are a really, really great way to build generational wealth for yourself and future ancestors. one of the other things that we look at on a very regular basis with our clients to help make sure that they're saving as much as possible is structuring their business and their entities in the most advantageous way. So that all starts typically with some sort of entity being in place as opposed to acting under their social security number, which a lot of 1099s start out doing, and then we have to kind of steer them in the direction of an entity. And a single member LLC that's created has quite a few benefits. It does provide some limitation of liability on, outside of taxes. And then it also is very simple, affordable to establish, not a lot of compliance requirements. Most people are eligible for a lot of business deductions related to it, and you can save a lot of money by making sure that you're structuring it just right for your specific situation. And a lot of times what that means is making an S corporation election on your entity. And some states or cities, for New York City, going to qualify there, it is not the best way to go, that S corporation. So you do want to work with someone who knows what they're doing, a firm that is well versed in all the different states and all of the nuances in local taxation. That way you're not making an S corporation election that actually costs you more as opposed to saving you. But in a lot of areas, an S corporation shields you from self-employment tax. And self-employment tax is nasty. It's at 15.3%. For a large portion of your income. So it's just no fun whatsoever. And that S Corp allows you to get away from that. And it also allows for a few other things like that pass-through entity tax election and sheltering those state taxes and actually receiving a deduction for them that we talked about earlier. Whereas if you do not have an entity in place, you're not eligible to make the PTET election. So it gets around that SALT cap of 40,000 for lower earners, or as you reach the higher earners, it is reduced at this point to 10,000 that you can deduct on your personal tax return. So it gets you around that and allows for also a federal deduction, which is great. And it does also, the S corporation, allow for enhanced retirement contribution options, as well as makes it very legal and above board to have that Augusta strategy deduction implemented there as well. So where we see a huge difference made is planning for these taxes versus just filing the taxes at the end of the year or in April. So with traditional filing, it's a reactive approach. You have really only the standard deductions available to you, and you're only considering it once a year, which really limits your planning opportunities. And there's no availability for personalization and optimization based on your specific situation, which can change things quite a bit. People don't realize, but everyone's specific situation allows for unique planning strategies that we can implement with you. So that's where working with a firm that gets to know you and works with you throughout the year can really, really come in handy, because they get to know your personal situation, how many kids you have, whether or not you're married, what your personal goals are, because not everyone's goals are the same. Some people are way more interested in a specific tax planning strategy that rather over another. So, working with someone who gets to know you becomes really instrumental in meeting your goals, as well as, not handing near as much money over to the government as you would with just traditional filing. So strategic planning, on the other hand, allows for the proactive approach as opposed to reactive. And it really unlocks some more advanced opportunities and strategies available to you. It does take ongoing implementation throughout the year, which is great because it keeps your mind focused on tax savings all year round and working towards that. And every little bit compounds on top of each other, like we were talking about earlier. So it's not just saving based off of one strategy or two strategies. It's all of them combined, really making it to where you're saving an actual amount that makes a difference for you.
Yeah, and just to add to that, with the planning, like as Kim mentioned, there's a lot of different strategies, and each one could be 5,000, 10,000. What we typically see, probably, and this is more of a conservative, we see anywhere we average probably around 50 to 100,000 a year. But even at 40,000, by doing all of these different strategies, the tax code changes as well. So we're always monitoring what is the documentation, what do we need to keep track of, how do we stay compliant, and if you're able to achieve 40,000 a year, that compounds to having nearly 2.3 million over 20 years, which is significant. But as Kim mentioned, this is very much a throughout the year process. It's not something you do at once and then you turn off and it just continues.
Yeah, year after year, you do have to keep at it, and you're able to typically find more deductions each year and more ways and or more money that you can save by staying keyed into and making sure that you're staying up with all the different tax changes and things like that. But we do see with the traditional filing alone a lot of missed opportunities. People who come to us that have missed opportunities in the past or would have missed opportunities if they hadn't come to us, such as real estate tax advantages. Maybe they have real estate, but they're just not aware that they could do a cost segregation study on their short-term rental and reduce their taxable income by a large amount. And that does not, by the way, have to be done in the year of purchase. It can be done any year after that as well. So let's say, you purchased a property and you're renting it out on Airbnb, but it was purchased 3 years ago. And then you come to us and you're like, darn, I wish I would have known about, this cost segregation study that could have saved me so much money. We can still make that study work for you 3 years later. We just have some compliance forms that need to be filed along with your tax return on our side, which we would take care of, but you can do that 3, 4, 5, 20 years after the purchase, and that is allowed. So keep that in mind. Even if you are not purchasing this year, we're still able to take advantage of some really great real estate deductions for you. And then 1099 contractor benefits. A lot of times we see people leaving a lot of benefits on the table that they just were not aware of that they could take advantage of as a 1099 contractor. And those advanced retirement strategies that we talked about a lot of times are not being implemented unless you are planning throughout the year for those. And that leads to that generational wealth growth.
Oh, Kim, sorry to interrupt. Jana had a great question just kind of on those advanced retirement strategies about the advantages of a cash balance plan over solo 401k for a sole proprietor LLC with no employees, and then the cost associated with a cash balance plan. So if you'd be able to just speak to that a little bit.
Yeah, absolutely. So the main benefit being the amount that you can sack away. So with a solo 401k, you are stuck at that 72,000 or 80,000 with the catch-up amount, and you can't go above that no matter what you do. With the cash balance plan, you do have to have an actuary involved, and the actuary tells you how much you are allowed to save based off of a huge number of different things, which is why you need an actuary, because it's very complicated, the steps that they take to decide. But you're able to sack away easily 100,000, 200,000, 300,000, large amounts of money. And that's the main huge benefit there. The only thing is that you want to take into account is that you do obviously need to be able to not have that money in your hand, because it is going to go into a retirement fund that, is outside of your cash flow for that year. So as long as you have that in excess that you don't need to live off of in this year, the main benefit is being able to sack away huge amounts. And you are actually able to self-direct cash balance plans as well. If you find the right fiduciary that allows for it, you can self-direct. So another really great benefit is that you could take those funds and invest in something like land or minerals or whatever tickles your fancy, and all of that money and capital gain that you realize from those investments is completely tax-free to you. So just like in a 401k where they're investing, stocks in the background and you don't have to pay capital gains tax on that money, same thing holds with a cash balance plan, but in a much larger scale. And if you choose to self-direct, it can be directed in certain areas that you choose. But that's another huge advantage in general for all retirement funds, but the cash balance plan just in a multiplied way because of the amount of money that you're allowed to sock away each year, is that capital gain tax-free growth of the funds within the retirement fund that you're able to see. So you may have only sacked away, let's say 20 or $200,000, right, for this year. But then if that is being compounded by investments, by the time you retire, that 200,000 could represent easily 600,000, in funds that you did not pay any taxes on and you did not pay capital gain taxes on as it grew. So larger scale, capital gain free growth, as well as larger scale contributions allowed each year.
And it costs probably, depends on who you go with, but probably ranges from like 3 to 10K. It really depends on who's doing the plan. But that's
it is definitely a little bit more cost heavy than a 401k for sure.
Yeah, that makes sense with the advantages there. Thank you for going through that. Really quick, we'll backtrack a second just as you were talking about cost segregation, and then I think we'll let you go, and then we do have some questions for the Q&A. But Emilio is asking, is a cost seg analysis potentially worthwhile for commercial building rentals that have existed for the last 25 years?
Absolutely. Could be huge, could be very huge. Now, the numbers would play a factor here. If it were a $400,000 property and a large portion of that has already been depreciated, your savings would be much less. Mm-hmm. If it is a $5 million property, typically a commercial property is going to be depreciated over 39 years. Whereas a cost segregation study busts out the different components like flooring and fixtures, cabinetry, things like that, and allows you to accelerate that depreciation. And in whatever year you do the study, you're able to take that large amount of accelerated depreciation as a deduction. And in this instance, where you're already 25 years in, you would just have to take that already depreciated portion into account as well. So it would be kind of percentage based, and at 25% of or 25 years out of 40, you're at that percentage, and you would just reduce the amount that you're able to deduct that year by that percentage. But it could still be very effective because 15% of 20,000, not a lot, but 15% of 2 million is quite a bit. So it just really depends on the numbers, but it absolutely could be beneficial still. And if you were working with a tax planning strategist, they would be able to help you kind of back into those numbers and see whether or not it makes sense. But cost segregation studies are also typically not that expensive, around 3,000, 3,500, somewhere around there. So even if you were to save $50,000 in taxes based off of this study, it's better to realize that savings now than to allow that savings to just be, spread out over the next 15 years to finish out that 39-year depreciation. So it's It's the same amount of deduction. You're just pulling it forward and taking more in the tax year of the study that was performed.
Yeah, that's definitely, and that's what we've done for all of our rental properties, which are all, there's 9 of them, but they're all smaller multifamily. But when you add them up, they kind of add up. Is do the cost seg and the accelerated depreciation. So definitely can attest to that.
Yeah, exactly. And something you can do when you have multiple units, like somebody purchasing a property with distinct separate units, can also use cost seg studies in very strategic ways. Like if you have a, let's say, 14 unit, townhome
mhm.
property that you've developed or purchased, you can choose to do a cost segregation study on just one or just 2 or 3 each tax year and reduce your taxable income by large chunks each year, but not taking out the entirety of it and wiping all your savings in that first year. If you don't have to, if you don't need to, right? So it can be implemented and used very strategically if you're with someone who, thinks towards those strategic planning actions.
Oh, very cool. See, I learned something new there. That's awesome.
Good.
All right. Sorry. Continue on with the generational wealth growth, and we have some questions we'll hit at the end. But this is fantastic.
Perfect. Yeah. And then deferred taxes is the other, huge missed opportunity that we see. It's something that you typically wouldn't even realize you have an option for a lot of times unless you have somebody in your corner telling you, like, we can defer taxes in specific ways, like a 1031 exchange, which allows you to instead of realizing capital gains for a real estate sale, you kick the can down the road on those capital gains and roll it into the next property that you're purchasing. So things like that are huge missed opportunities when you're just filing as opposed to planning. So some real results here, right? Not just talking about some fake numbers out there or some fake situations out there. We can talk about an actual plan. Of course, the name has been changed here, the Dr. Coleman, so that patient confidentiality is kept in place and all that, or not patient, client confidentiality is kept in place. But we do see some really awesome results. And as you can see here, hopefully you can see the numbers are a little small here, but this is an example of someone that's in a 29% federal effective rate here, because they're in the highest marginal bracket of 37%, and then their home state is 5%. So that's what all this is based off of. And then the income being 150,000 W-2 and 375 in 1099 there. So we've, in this example, done an S corporation election, which is saving them somewhere around 8,700. We're implementing the Augusta rule strategy. That's that rental that allows you to rent your personal residence to the business. That is a deduction of around 12,000. So between state and federal, you're saving around 4,440, and so on and so forth with paying your kids, retirement, solo 401k and or SEP. You have the real estate cost segregation study that we were talking about earlier. The deduction here is 125,000. So that is around a $500,000 property that we're taking into account here that they did this cost segregation study on, which is saving them $46,250. So real money put back into your pocket. Not all of it is just these small ones adding up, but as you can see at the bottom there, when they are all added up, your estimated savings is $107,583. So you're putting that back into your pocket for future investments that can be tax advantaged as well, which will just compound more and more savings. So this client took into account mileage deduction, some additional travel that they probably wouldn't have taken into account if they hadn't been working with a tax planning strategist, vehicle purchase, interest, and insurance premiums, and then some other typical business expenses. So between all of those total deductions, $322,250 and over $107,000 in tax savings, just from doing some personalized tax planning, evaluating the different ways that they can make sure that they're implementing tax strategies to their best advantage for their specific situation, and just having that step-by-step guidance and implementation from a tax planning strategist. So here at DocWealth, a few things set us apart from most firms, even including other ones that do the tax planning. Most of them don't have the level of service that we offer. We do have a dedicated education platform that is physician specific. So every one of the articles and knowledge base items do take into account physician specific and high net worth types of scenarios. We have tutorials, examples, all sorts of ready to use templates, things like that. And then within that same platform, we also have direct messaging that keeps you in contact with your tax team throughout the year. So not only do you have meetings throughout the year with your tax manager that you get to take advantage of and, really pick their brains on different ways to make sure you're saving the most money possible, but then also throughout the year, if you have a question, you're going to purchase a vehicle and you just want to know what things you should take into account, best ways that you can make this purchase and that leads to the best tax advantage, things like that. You have access to your team year round. So not just at, tax filing time or just during those meetings that you have, but with us, you do have that year round access. And we do have concierge level service. You have a dedicated tax team with a tax leader that you will work with every year, all year. You have dependable communication. We're very prompt. We pride ourselves on very prompt communication and getting back to you within a couple of days of any message that we receive. And we can help you with entity creation, payroll, bookkeeping, planning. We have all of that in-house. So it's really a one-stop shop. It really makes it easy for you to implement these different strategies as well. And very transparent. We're even so transparent that we have our pricing on our website, which is almost unheard of in the accounting industry. But we're very transparent about all things with our clients. And then, of course, the bread and butter and where the tax savings really come in is the customized tax plans. So it's not cookie cutter, one size fits all. It is optimized specifically for your situation, including everything. Like I said, how many kids you have, whether or not you're married, all the different items that make up your specific scenario all lead to special tax deductions that we can optimize for you. So we take a really hands-on approach and implement those alongside you. And we think about the year ahead of us for executing tax savings as well as in the future, like what will next year look like for you and how can we plan now to make sure that we're compounding these tax savings as much as possible. So we design your tax savings and implementation around your personal goals and situation. And that's really where the bread and butter comes in, as they say, right?
Yeah. And just to add to that, we've really made it a focus to be pretty unique in the space. And that's probably why we've had, so much adoption. Almost everyone who's joined us has been referrals. We have over 1,000 positions. And the goal is to make it as streamlined as possible, where we're saving you time and the savings as well, while staying compliant. So that means getting the best experts across the country, like probably one of the only firms that has tax attorneys, the payroll specialists, international tax, different like investment structures, trust. So whatever level of complexity, even if you're starting out to getting all the way more advanced things, we do everything in-house. Nothing is contracted out, nothing is outsourced. And that really leads to kind of the high quality that we're shooting for. I also saw a question like we do all the preparation and the filing. So everything like accounting and tax related is done within DocWealth.
Yep, and we have just seen astronomical success because of these exact things that do set us apart. And so the tax planning alone is great, but when you compound all of this together is where we've really seen a lot of success.
Cool. Yeah. Maybe we can just jump to questions given the time we have left. We can answer some of the open questions.
Yeah, no, that's fantastic. And I don't know if you have on there or we can put in the chat like how best to reach you guys. We are going to send a follow-up email to everyone with the recording and we'll have it there. But just if people have immediate questions as well, because this has been really incredible. We'll do some quick hitters. With a solo 401k, can you still contribute to a non-deductible traditional IRA or a Roth IRA?
Yes, you can. You can contribute to both IRAs, solo 401ks, and cash balance plans if you want it in the same year.
Beautiful. Since with an S corp you have to take a reasonable salary, in quotes. If you're doing locums work, does it make sense to do a cash balance plan over and above a solo 401k?
It could. It really depends on the income level.
Okay.
It would have to be a lot of income to make sense.
Gotcha. We've got one just saying, do you have enough faculty to take care of all the clients? Because you may reach more than 2,000 after this video, which is hard. And
yeah, we do, and we're constantly growing as well. I have many interviews every week to continue to grow because we're growing at such a fast rate already.
Yeah, and just to add to that, like our focus is very much personalized nature. So even as we're large, we have all the bench strength and more than 40 tax professionals in-house. But we do a pod style structure. So you have a very personalized team of 2 tax professionals, not just one, so that they get to know you. And that's how we have really fast communication. Typically within a couple of business days max, you're always getting a response. And so that team has very set number of physicians, and we've already hired multiple tax experts, ahead of time. So that's never been an issue so far. And yeah, like Kim said, we are interviewing for the best talent across the country all the time. But we staff far, far ahead. So it's never an issue at all.
Awesome. Yeah, that's the only thing I'll kind of add from my own personal experiences. Like I agree and truly feel that, well, hopefully this presentation showed, even if you think there's nothing I can do about my tax situation, there pretty much always is. And even if you're like, well, I'm just straight W-2, whatever, you can start 1099, whether it's through a little consulting or whatever you're doing, and harvest so many of these advantages, which is basically what I've done as a W-2 earner for my clinical income. So it can be done and it's so powerful. But this is where I'm a very, staunch advocate of, if you want to, you can definitely be a very successful DIY investor. I don't recommend being a DIY tax advisor. Like you want experts like this helping you come up with a plan, but also following it through, because as everyone knows, the IRS is very down into the minutia, and you want someone who really knows everything. And as physicians, we have a lot of unique features, and I think that's such a cool thing about DocWealth, that it is tailored just for us. So it is awesome. I remember, talking to you guys when you were just kind of starting, and to see all the amazing growth is just incredible, and a testament to, like you said, the service you offer and the level of personalization. So I know, like, I learned a lot of different stuff and stuff I'm gonna, probably email you guys on the side about. And I do really, really appreciate your time and coming on and talking with us. Appreciate everyone who joined live and asked questions. Everyone who's watching the video replay, thank you. And here's the best way to get in touch. So Laxman, Kim, thank you so much again. You're always a wealth of information.
Yep.
Yeah,
And any
thank you, Jordan.
questions that we didn't get to, please feel free to email them on over. We're happy to answer.
Perfect. Well, thank you guys so much. Have a great night.
Thank you.
Thanks.
Bye, everyone.